Hello, everyone, and welcome back to Global Campus Group. In this lesson, we will study statements of comprehensive income and statements of financial position. These are two of the most important financial documents in business because they help us understand performance, financial position, profitability, liquidity, and efficiency. A business needs more than sales figures to judge success. It must also know whether it is making profit, whether it can meet short-term debts, whether it is using its assets effectively, and whether its overall financial position is strong or weak. In this lecture, we will first look at the statement of comprehensive income. Then we will examine the statement of financial position. After that, we will look at how businesses use these statements to measure profitability, liquidity, and efficiency through ratio analysis. Finally, we will consider the limitations of ratios. A statement of comprehensive income is a financial document that records an organization's income and expenditure over a specific accounting period in order to show profit or loss. The key elements are revenue, the total income earned, cost of sales, direct costs, gross profit, revenue minus cost of sales. Expenses include indirect costs like administration. Net profit after tax is the final profit remaining. A statement of comprehensive income must also include important accounting adjustments. Depreciation is the reduction in value of a non-current asset over time. Prepayments are expenses paid in advance. Accruals are expenses incurred but not yet paid. The purpose of these adjustments is accuracy for the period. We now move from performance to position. A statement of financial position shows a business's assets, liabilities, and equity at a specific point in time. Its purpose is to provide a snapshot of financial health. Non-current assets are long-term resources. Tangible assets are physical items, while intangible assets are non-physical items such as goodwill or patents. Current assets include inventory, trade receivables, prepayments, and cash. Current liabilities are short-term debts like bank overdrafts and trade payables. Net current assets is the difference between these two. The owner's claim on net assets is called equity. We now move to ratio analysis, beginning with profitability. Profitability is the ability of a business to generate income that exceeds its costs. Gross profit margin and markup are key. Liquidity is the ability to meet short-term debts. The current ratio and liquid capital ratio help managers judge if the business is under financial pressure. Efficiency measures working capital control through trade days and inventory turnover. Although ratios are useful, they have limitations. They are based on past data and depend on record quality. They also ignore qualitative factors like staff quality and brand strength. Ratios show a problem exists, but they do not directly explain why. Ratios should always be interpreted in context. In summary, the statement of comprehensive income shows performance, while the statement of financial position shows position. These statements allow us to measure profitability, liquidity, and efficiency. Thank you for watching this lecture on statements of comprehensive income and financial position. I will see you in the next lecture, Global Campus Group, Shaping the Future of Business Education.